All right, stocks are showing a couple of days of a weakness here, about as weak of weakness as you could possibly get. But we'll see if this is enough. How is this weakness in context of the prior move to suggest whether or not it's enough? And here we go again for the rest of this week into next week, or is there more to come? So we're going to break down the technicals there to kind of evaluate where any kind of quote unquote pullbacks can go to, and how we can move, and how where the kind of the range is for of where the S&P can kind of move just in up and down noisy patterns. So I'm going to show you that. We're going to break down the Fed's decision today, what it means, and how it compares to previous Fed decisions, and kind of reconcile this idea of the Fed keeping rates low and having this QE forever type program on while the stocks are at all-time highs. So we're going to break that down. Then our trade idea of the day is a stock that's showing a really good strong pattern, has its own potential for near-term weakness. So we'll talk about how to trade and how to accommodate for that in our trade idea of the day. So let's go ahead and get started. Today is Wednesday, June the 10th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you see we have a bullish intermediate confirmation signal for the second consecutive day, this time with a near-term line also below 50. And if you take a look, this near-term run was rather large. Like, it started back with this little dip right here. This is the first dip, then this little dip that started from this low point, and then the near-term run started from there and went up to that point. So you notice here that if I were to throw on that 23% retracement, to kind of give you an idea about this intermediate confirmation signal, you can see that this decline didn't even hit the 23% retracement level of the near-term rally that we've had, much less the intermediate rally off of the intermediate low point, which is way down at the beginning, actually, of this near-term run. So to kind of give you an idea of like how likely or unlikely it is that we can drop this 7%, right? This 7.5% from 0 to 23%. That 7.5% run, how likely or unlikely is it to happen? Well, that's pretty much the length of this last near-term rally. So, if we were to ever have a 100% retracement of that near-term rally, or even just a 78, if I were to edit this and throw this on here, you'll notice that even coming down to the 78%, that would be a move down to the 23% line. So it kind of shows you it's not out of the realm of possibility at all. It wouldn't be, and like I said before, it wouldn't even be classified a pullback. It would just be noise, right? A pullback won't start until you break the 23% line. And again, obviously a 7.5% pullback would be considered a pullback, a pretty deep pullback in most any other market. But you have to remember, there's a 47% rally here. 7% in the context of a 47% rally is nothing versus a 14% rally or a 10% rally off of an intermediate line. So that kind of gives you an idea, some context, and especially with this last near-term rally. Now, so again, how likely are we to bounce off of this? This is a bullish signal, a strong intermediate posture, oversold momentum line, now with a near-term line below 50. Very, very strong signal. The problem is that here again, we haven't even touched the 23% retracement of the near-term pullback. So, at some point in time, you would expect potentially at least another day. I mean, maybe on a near-term basis, maybe even just filling in this gap from right here on the 4th or the 5th, filling in that gap down to the 38% level. I would say that's probably the most likely scenario in any kind of near-term decline that we might get in another day or two and then bounce off of that. That's kind of our best case scenario. Our worst, we can bounce off of this too, like right now, and that's unlikely, but it's also, I guess that would be the absolute best case scenario if you're bullish. But the more likely, and probably the actually better case scenario, is you do pull down to at least this 38% level. Then you've had at least enough of a pullback that you can get a new near-term run that can last 7 to 12 days. If we were to bounce right here without even a 23% retracement, then you would you'd start looking for divergences out the wazoo on that. So that's kind of the idea there, and you can see again, pulling all the way down to 78% would just be noise, like literally would just be noise because of how big this rally has been. If you take a look now at like some of these others, like the Russell 2000, you can see it's had a really bad couple of days. So as bullish as it's been the last week, really few weeks, it's given back a lot. In fact, its near-term line, its momentum line again fell to extreme lows. Its fourth extreme low here, during this rally. And we're not getting big highs, and the only one that we got really was that one right there, where we got up to the 90th percentile, but that was it. None of the rest of these coming off these lows even got close to the 80th percentile. So big down days and coming off these rallies, and that's what we're getting right now. And we'll see if this turns out. The last time we got this, we had some weakness there for a few days. When last time we played catch up on the Russell, it produced that period of weakness, and there's possibility it could produce something like that again. We'll take a look at the 3 green arrow chart here in just a second. The NASDAQ composite, however, is like, it just keeps moving, right? So, and that's good. We talked about the leadership, this leadership shift to small caps. We don't want the leadership shift to small caps. We want the Qs who have been the leadership well before this coronavirus stay-at-home trade emerged. We want it to regain its leadership, and now it's over 10,000. Now that's a big round number, and a lot of times once we hit big round numbers for the first time, they kind of act as magnets, and then we break through, and then it takes a while to get back up to them. That usually starts a period of weakness. And you remember, we can drop down here to 23% retracement, and that would be a almost 8% drop down to the 30%. And we talked about before, I think my worst case scenario is coming down to the 38% eventually, maybe not in a day or two, but eventually coming down there, breaking, starting a retracement, getting dark pink shading in a red line, and then chopping between the 0 and 38% line. Now that the 0 line's at this important 10,000 number, kind of chopping in here for a while until it can finally break it, to stay. Now that happens a lot when you're looking at big round numbers like that. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here, click the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video. Number two, you want us to do a video again tomorrow. It's a quick way to give us feedback and let us know what you're thinking if you like our videos. If you want to let us know you like them, you can click there right now while you're watching. If you don't like them, then you don't have to click on anything. And then also, too, comment. What questions or comments do you have about anything we talk about in these videos? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow us on Twitter for more content in between the videos. My address there is @DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our website here, we invite you to check out some of the other things, including our Market Outlook live video. You can see right here. If you click on this image, you can watch today's Market Outlook live as well as all the other archives. This is where we review all old trades as well as manage, as well as put on today's trade before the market closes. We do this at 3:30 Eastern time whenever on the days I do the Market Outlook videos. You can also get to that right here. If you mouse over Market Outlook here on the top and click on Live Trade Review, you can find the same thing. Our monthly subscribers get access to these, including this as well as all of our trading rooms. Our premium subscribers get access to all of that, plus our Q&A sessions. You can see Brandon's is due tomorrow. He's our next class up, as well as all of our premium tools and resources that we have there. So you can see the two different plans we have. If you click on the word pricing, that will compare the two for you. Also, we invite you to engage with us on social media. Click this heart. It opens up this new window. Hit that like button that pops up there. Hit this thumbs up. That takes you to your Facebook page. Like today's Market Outlook Facebook post. Again, it benefits us because the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers. It benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's get back to the charts. And let's take a look at the weekly chart here for the S&P 500. And again, as this little bit of weakness that we've had, you can see how strong that bullish candle. It's really hard to go from a really strong bullish candle like this to a really strong bearish candle. So that's most likely not going to happen. And if worst case scenario, next week we get some kind of transition. But keep in mind that for that to happen, for us, next week's open is going to be around 31.21. We'd have to lose 70 points this week to even consider the possibility of a transition candle next week. So this kind of gives you an idea, like any weakness we get, and that, again, that's way above the 23% line. So, to drop to the 23% level, we're going to get this kind of move where it's a reversal down, just like we did here, right? This was if I were to activate this drawing here, there we go, and just reverse this move from top to bottom here, then you can see, and throw on the 23% line because that's not on there for some reason. You can see, we did get some bearish candles to a 23% level move. And now we eventually, on an intra-week basis, we closed at 38. But you can see how the Hakunashi stayed at the 23% level. So keep in mind that that's eventually a possibility that's bound to happen. And that occurred after the Golden Cross, right? So, and we're just now getting the Golden Cross. Here's the Russell 2000. We're not getting the Golden Cross yet. And also took a while longer over here to get the Golden Cross, longer than the S&P. So that's typical, and it's also not crossed above the 78% level. So it caught up to that resistance level, and so far is held for resistance. Let's take a look at the 3 green arrow chart for the S&P, which has 3 green arrows really easily. But if you take a look at the 2 line versions of this, you can see you're well above the 8-day moving average. So again, take that weakness for what it's worth. We are well above. Now, in the after hours here, we're down a little bit, down to 316. But even then, today's low point is 318. 316 is actually still up above this 8-day moving average. So again, take any weakness here with a big grain of salt, and that 23% line's well up here. And really, we don't start to concern ourselves with any kind of intermediate pullback until you break the 17-day. And even there, when we broke the 17-day, we got right back above it a day or two later. In fact, the next day, we got right back above it. So typically, when you break the 17-day, that's when you start worrying about the dark pink shading and red line on the market forecast. We are well up above the 8-day. So, and we can come down to the 17-day to 307, 306, and still just be, in fact, we can actually break the 17-day and flirt with the 30-day and still be inside the 23% retracement level. So again, kind of gives you an idea of what kind of move can just be noisy move because of the extent of the rally that we've been on here. You can see also the RSI and CCI remain at strong levels, right around the 100%. They're not flirting with the lower end anytime soon. The DMI is also at strong levels. The Bollinger Bands, we remain above the point of control. Again, a move back down to 300 would remain at the point of control and still be easily, like I said, I think that 23% level is right around here, where even in just as big a point of volume node is right below that. So you can almost kind of call this whole area one big support level around the 23% retracement level. So you kind of get an idea. We haven't broken out of the value area. It's still kind of holding for resistance there. If you look at the Russell 2000, again, we hit resistance at the point of control, and now we're breaking, kind of coming back down a little bit. And again, we'll see how far, that's where its 23% level is, right around that blue line. We'll see how far, if we get any weakness, how far it comes down. Finally, take a look at the Ichimoku trend strength. You see how strong it is on the daily basis, how far up above the green line we are, and then your blue line, again, just about right where that 23% line is. You come down to it and break a little bit below it and hit the 23% and close there, very good chance we bounce right back up off of it. All right, let's take a look at the intraday chart and how this moved. You can see the very small, in fact, the last 2 days, and especially in context of this move, how small the ranges have been. You also see too, like, we're not filling in that gap yet, and that's kind of the idea, like, we expect that to be a common gap. We'll see if it fills that in. Now, granted, this was the break above the 78% level on the S&P. We'll see if we fill that in, and remember the 23% retracement level is right about in the, well, you can see it's right there in this area, right at the 50% retracement. So there's our move to come down. That would leave this gap still unfilled from the very beginning of this move that we started with. But very small ranges until the end of the day. It was after the Fed meeting where the volume really picked up really strongly at the end. In fact, when you take a look at today's volume, it was really light until that last push. We have average volume, but a small range again. I mean, those are pretty decent numbers. Like, without being, we don't want to spike, and we're most likely not going to get a spike in these. But these, if we get volumes above average, if we get volumes above the ATR trading ranges, above the ATRs, then we know we're getting that 23% retracement. If we stay down, then we know that we're just getting these small grinds, right? These small little near-term pullbacks that aren't even much of anything. So we'll kind of keep our eyes on that and see how the ranges and the ranges and the volumes play out relative to their average. You can see the volatility is picked back up into the neutral range. So after kind of closing below it here for a few days last week, we've gone back up above and kind of flirting with the high 20s again. And after breaking down below this about 25 level, 26, we're back up above. So now the question is whether or not we'll really break out of this to the upside. We've talked about before this VIX has really been compressing its range. Its range has been getting smaller and smaller, especially if you look at it on a. Sorry, this seems to be. I think I need to, but you can see, this is on the 14-day ATR to price ratio, how low it's gotten relative to where we've been, right? When we were kind of hitting this support in this area, we've kind of gone down. And instead of using these highs for a support level, now we're using these highs for a support level, and we'll see if we bounce off of that, as we did a few times off of those levels, and get a run up in volatility. So we'll see. Again, volatility's ranges have been relatively small too, so you can watch for volatility to have bigger ranges in the 4 points. Otherwise, if we keep compressing, then we finally come back down towards this 8.5% mark. That's kind of where the low point is. That's when we, that's as we trend higher, that's where you would look for it to eventually work its way back down to. So to summarize our technical outlook here before we look at some other charts, we have this bullish trend. There's, a little bit of weakness here. Nothing like trend changing. And any weakness we get, all the way up to that 23% level will just be in noise, just up and down noise. But we also, we kind of have to watch to see, with how small the ranges have been and where the volume has been. If we continue to have small ranges, then we know that these little bouts of weakness are just quick short-term dips, and we'll just grind higher with smaller ranges, smaller volumes, and the VIX will keep compressing. If we start to get anything bigger than average in ranges and volume, then we know we're going to get more of that 23% retracement. And remember, we can come down to that level in a matter of just a few days. That we got up, we extended away from it, and on the current near-term rally that we're pulling back from now. So we can come down 78% of that near-term rally and come to it. So, and that can happen. It took about 10 days to form. It can take just a few days to come back down. So we'll just kind of keep our eyes on that. And like I said before too, if we do come down to that level, it's going to be a really decent, probably one of our better buying opportunities that we've had in a while, because we haven't had any kind of 23% pullbacks for quite a while. So keep your eyes on that. Among other things, we talked about the Qs and that intermediate confirmation signal right now that we're getting on the market forecast that can lead to a bounce back up. Remember, bounce back up won't be big bounces. They'll just be small, slow, grinding bounces, and we'll keep our eye on the leadership of the market as it does, because we are very strongly in the trend. The intermediate posture that we're on is getting very mature. 44%. We've gone 47% to the upside without a 2-3% or was a 5% pullback. So It's quite the mature rally, and at some point in time we will get a 5% pull. In fact, we can get a 5% pullback without even being a pullback, right? Without being a retracement because of how big this move has been. So we'll keep our eyes on them. I mean, that's something like that's coming soon. We've talked about risk reward, any new directional trades. The risk is getting larger and larger. So it doesn't mean that we can't keep going up. It doesn't mean that we can't make bullish trades from here. It just means that we have to take into account the risk, right? The risks are getting bigger and bigger in the short term. In the long term, it's looking great, and we'll talk about that more here in just a second. So, what do you think about the technical outlook? Do you agree with it? Do you disagree? Comment down below, especially if you disagree. Comment down below as to why. What are you seeing that suggests either you're a lot more bullish than I am, that we're not going to get a 5% pullback anytime soon, or you're a lot more bearish than I am, that it's going to be a much bigger drop than just a 23% retracement if and when it does come. So let me know what you're seeing that would suggest that down below. All right, now let's talk about what's driving the price action. We had a really good discussion today in my options inventory class. So again, it's recorded. Let me show you here really quick. Right here, there's a recording to our options inventory class. We talked about what the Fed did today and their decision and the impact it had in the market. So remember, our plus subscribers right here get access to all these recordings. So you can go check this out here tonight or tomorrow, and it's a really decent discussion. One of the main things that we talked about was this idea of the Fed keeping interest rates at 0% and having, because that's what they said today, to keep it in at 0% for a few years, as well as QE, having an ongoing QE program with the market at all-time highs, practically, right? Especially the NASDAQ. Well, one of the things we talked about was back in 2013, that was the case, right? We had 0% interest rates. We had QE3 ongoing all the way to here, to October of 2014. QE3 went all the way to that point. And we were at all-time highs on the S&P 500 with 0% interest rate. So this would not be the first time the Fed has done this. And with unemployment as high as it is, and unemployment doesn't fall very fast, right? It jumps very fast, like the VIX. It jumps really fast. It doesn't fall very fast. It usually takes a lot longer. So that's going to leave open the door for the Fed to continue to be very accommodative. So when you consider that you also have inflation expectations at really, really low levels. So if I were to take a look here at inflation expectations, let's just go to a year chart on this so we can keep it in scale. Hasn't been updated yet for today, but you can see we're at 1.5%. Just for some context on that, in the last 10 years, that's still some very, very low levels of inflation. And when you look at the expansion of the Fed's balance sheet, here's the current expansion, how strong the Fed's balance sheet has grown here with this big jump. And you notice we were already rising. The Fed's balance sheet was already rising pretty much since this level, right about September, the end of August of last year. And you notice that we talk about this bear market and risk appetite as a whole that started in January of 18. Well, you notice it started when the Fed started to decrease. Okay, let's go to the Hakinashi. The Fed started to decrease their balance sheet from January of 2018 all the way to about August, the end of August, early September. And the Fed started to raise their balance sheet, and then obviously really took off here. Very similar again to 2000. You notice when you look at the PPO, the expansion of the balance sheet back in 08, the end of 08, beginning of 09, was a lot bigger than what we have right now. It's pretty big, and it's bigger than QE3. There's QE3. You see QE3 is a lot more gradual. This is QE2. You can see how QE2 is relatively gradual as well. In fact, QE2, the pace of it was about the same as QE3. And then you can see the only negative we've had here in the last little bit is this drop. But if you take a look at how the markets have performed during this time frame from January of 2018 all the way up till all the way up to that September time frame. So if I were to come over here to that August 26th of 2018, and it was about August, let's go to the end of August of 2019. So this is the period where the Fed let their balance sheet come back down, right, by letting assets that were maturing, by not replacing them. If you notice, I mean, look at how the market performed. Look how strong the dollar was during that period. The long-term bonds were up. Gold was up. Look at QQQ was also very strong during that time as well. You have foreign bonds were up. I mean, this was a risk-off market during the time that the Fed decreased their balance sheet. Look how volatile the S&P was in that first quarter of 2018, the second quarter or fourth quarter of 2018, then this little dip we had in the middle of 2019. You can see during this entire period, the S&P was only up 3%. This is more than a year, about a year and a half. Small cap stocks are down. Look how big emerging markets and developed markets were down. So again, there's your bear market that we have in pretty much risk appetite. You can see commodities also down significantly versus the period where they increased their balance sheet, right? Which is let's actually go back to I wanted to show you one more. Let's see if I can find that symbol again. Let's actually just come over here. From this period, after they increased their balance sheet up to this level, like this big spike, then we had some ups and downs. But you notice for the next, really pretty much until until November 2010, it kind of was pretty choppy. The balance sheet was pretty choppy. And you can see from July of 2009 it rallied up. And then you can see this period from 2011, from August 2011, where the Fed, they did Operation Twist coming out of the credit downgrade. So they couldn't increase their balance sheet, but they extended the duration of it, and they kept things the same. And then this big spike. So if you take a look at really pretty much from December of 2008 all the way to about November of 2010, if we take another comparison, so immediately after they bounce the interest rates or the balance sheet up to where they're at, so 2008 December, let's go December 1st, all the way to about November, let's go November 15th of 2010. So that's after it spiked, all the way up to the time that QE2 started. This is how it performed, and you can see, the dollar was down. This again post spike, so we've already had the spike in the balance sheet. The dollar was down, rolled over that period. Bonds were down. Commodities were up a little bit, but look at gold was up significantly because of the falling dollar, 64% in a matter of a year. Look at Qs, and emerging markets are all rallying. Qs way outperformed IWM. IWM outperformed SPY. It was the biggest mover. And if I did the same thing for the sector rotation, if I were to move this now to the sector rotation for the same time frame, so December 1st, we'll go to December 1st of 2000 and what was it? 2000 or 8. It was November the 1st. November the 1st of 2008 all the way to November the 15th of 2010. That's actually kind of, what was it? Was it November? Let's see. It was right, December the 1st. Okay, so let's do the same. Let's go back to this chart. December the 1st of 2008 to November the 15th of 2010. So almost 2-year period. This is how the sectors perform. You can see your cyclical areas: technology, discretionary. You probably would have had XLC up here too. It wasn't in existence back then. You can see the weak dollar helped materials go up. Energy lagged a little bit behind as commodities kind of lagged, but materials did very well. Industrials did very well with the weak dollar. And you can see all your safe haven assets with the dollar up 33%. Your utilities and real estate didn't exist back then either, but staples were down. Healthcare lagged behind. Financials lagged behind. Now, financials are going to be really dependent upon what happens with the 10-year yield. And you can see, the last few, we had a nice little breakout on the 10-year yield. The last 3 days, including today, even after this Fed announcement, that yield's come right back down. The expectation is inflation expectations aren't nearly as strong, and we're seeing a pretty significant decline. Now, this is was an intermediate confirmation signal. It didn't play out, and we'll see how much this reverses with the light pink shading already. And the significant pressure, the downward pressure this long-term trend has on, we're already back down below that 50-day moving average. So we'll see how we finish this week. If we finish back below the 50, it's not the best sign. Doesn't mean, we did that here. So, we went down a couple more weeks. We didn't go to lower lows, but it just kind of slows us down in terms of, and that will put pressure on yield, on the financial sector, if yields continue to do that. On the other hand, you can see commodities had been rising up to really good levels. Again, inflation expectations pushed commodity prices up as well. And we saw that they didn't do so well during that period post balance sheet expansion. So we're talking about after the spike, now this kind of choppy up, up and down sideways period. Post that spike in 2008, at the very end of 2008 when they did QE1. So commodities lag too, commodity prices, even with the weaker dollar, and we've been talking about how weak the dollar's been, and you can see now it's continued down this week. We're getting a death cross on the dollar with the PPO crossing below zero. There's a weakening dollar is very bullish for equities. We saw how bullish it was, again from that same period of 2008, December of 2008 right here, where the Fed, after the Fed spiked their balance sheet, it went up, and after, from that period all the way to December of 2010, that's how much the dollar went down, in the same exact kind of time frame that we're in right now. So as the Fed kind of slows down the expansion and just kind of chops in sideways, we've seen how the dollar's performed in the past, and that's allowed for really, really good performances, in international stocks as well as in U.S. stocks, specifically in QQQs and IWM. Right, IWM still outperformed, but just not to the same extent as that tech leadership, large cap tech leadership. All right, so that brings us to our trade idea of the day, and the stock I wanted to take a look at that's got a really strong pattern is AbbVie. It's got a nice little market forecast, a little bit of a hanging man candlestick pattern, so we'll see how that plays out. It had, by the time we were looking at this, it kind of pulled down late. But by the time we looked at this, we had broken, but we still are above the upper Bollinger Band, which is a good sign with a rising bandwidth. We had also broken up through the Keltner channels. So you can see that's a very good sign. Now, again, it's a one-day candlestick pattern. We got some resistance at the top here, and we'll talk about how we handle that with the trade, with the strategy that we employed. You can also see too, this little intraday decline we had still kept us well above the 8-day moving average, and especially well above the 17, which it has been using for support. So, and the 17 days at the 92.5 level, that's going to be important for us going forward. Rising MACD average, you can see the the DMI is strong. It's got strong pattern there. The RSI and the CCI also have bullish patterns. They're at higher levels on those despite the pullback. So so we got a strong chart, the possibility of a short-term pullback. So what we've done to accommodate for that is we just did a bull put spread, selling this 92.5, which remember that's where the 17-day is currently, and that's rising. So the 17 days is actually going to be well above that by the time we potentially test it, and then bought the 90 for protection. You see I did 6 contracts. So what I've done there is set up a full position size because I don't have to worry about earnings into July expiration, and then we're going for a $400 reward for the $1,000 of risk roughly, which means again that I don't want to take the full $1,000 risk if I'm willing to lose $400, which would be right down below this 92 level if and when we were able to get to that spot. And you can see how much we've already moved down. I mean, just in today since we got into this trade, and that's in the last half hour of trading. So we'll see how that plays out and bounces out. We're down a little bit already into this, but I'm down $85. I'm willing to lose $400. So that gives us room to work with on any declines, on any pullbacks, to see whether or not we bounce up or not. All right, and that does it for today. You've heard from me now. Now I want to hear from you. Just use that link right there. It's popping out in the top right corner of your screen. It takes you to our Market Outlook forums. And let's keep this conversation going. Open up any new thread with any questions or comments you have about what we talked about today, or apply to anybody else's thread. Again, I appreciate you watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video down below. Follow me on Twitter for more content at DavidSettle42, and then join our Market Outlook Facebook group that we have, as well as our community at MarketScholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.